100.3 The Fan.
Welcome to your commercial-free, uninterrupted investment show, sponsored by the SEC-registered investment firm, Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who has been putting clients' investment needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. Thanks for joining the show today. A lot of great things to talk about. We're going to talk about economic news. I mean, that's very important right now. It's really scaring people. We'll talk about some things that maybe will make you feel a little bit better. Talk about apartment rents. We've talked about this before. Also, too, capital gain taxes. Got some interesting information on that for you. And then we still got to talk about the crypto market because we keep saying that slowly, one by one, they keep falling apart. So we want to keep you abreast of what's going on in the crypto market. And back from his honeymoon from Bora Bora, back in the house is Chase. Chase, great to have you back.
Great to be back. You know, it was a lot of fun while I was gone, but it feels weird to be gone for too long, and I miss doing the show, so happy to be back.
And you know how to hit all the buttons and everything?
I was like, is my mic on right now? But no, we're good, and, you know, happy to be back, and happy to take your calls as always. You want to join the show, phone number here is 833-288-0973. Again, that's 833-288-0973. And it was crazy because, you know, in Bora Bora, the weather was, you know, 80s every day.
Right.
It's like temperature controlled, like 78 to 82 the whole day.
Is it humid? It was probably humid.
It was humid there, yeah. And then, you know, I see back here it's raining, and then there's snow, and I'm like, oh my gosh, people are talking about having issues flying into LAX because of potential snowstorm. I'm like, oh man,
right.
Great time to be gone.
And one thing we have to do, Chase, is we got an email from Tom probably about a couple of weeks ago about 3M. We got to try to hit that today because it's been MIA folded to do. It comes up, and then we don't get to it. So let's try to hit 3M today for Tom. I guess he listened by podcast, so he'll get it that way. But let's move on and talk about the economic news because some people wonder why I don't get so upset over the negative economic news that comes out. In the first half of last year, I kept saying, yes, it'll be a difficult year, but we're not going to have a major recession. Looking back at some headlines, and I just love doing this because it really makes you realize, like, oh, that was kind of silly. In March of 2022, Goldman Sachs economists were forecasting a 20 to 35% chance of an economic contraction within 12 months. The CEO of JP Morgan Chase, Jamie Dimon, used the word hurricane in the economy going forward, and Bank of America predicted a mild recession would hit before the year closed.
And I got to say, too, that Jamie Dimon thing really upset me because I remember looking at that headline.
Mm-hmm.
And then, again, you read the article, and he's saying basically, you know, we don't know what the potential effects are going to be from, you know, monetary tightening. And there could be a hurricane. Right. There's hurricane clouds building. But then he also said, you know, but things could kind of go on, essentially, and paraphrasing, of course. And it's, of course, that headline that's a negative one
right.
that makes the news, not the one that says, well, you know, things could be okay.
And I'm glad you brought that up because it is true because he actually kind of said, well, that's not quite what I said. He used the word, but the media just blew it out like, oh, see, we're going to have a major problem economically and so forth. And they just want to make things as bad as possible. And that's why we look at what we call raw data and don't listen to it. And again, we respect Jamie Dimon. I think he's a great CEO. But we listen to the other words, not just that soundbite they pulled.
Yeah, I mean, because you listen to the CEOs still talk from the big banks. They're still talking how consumers are still spending. They have all that data from the checking accounts, debit cards, credit cards. And again, the consumer's still there, and they've talked about that. But no, that doesn't make the news. And actually kind of talking about that raw data, looking at the numbers, fast forward from the fourth quarter of 2021 to the fourth quarter of 2022, the U.S. economy grew at 1%. It's easy to be negative, but one really must look, again, at the data and say, where will we be 12 to 24 months from now? I think our economy will continue to move along and inflation will continue to decline slowly. With that said, I will continue to invest in good quality public companies and see what they will be worth in the next 12 to 24 months as well.
Yeah, and this is one thing that people get so upset, like, oh, you know, things are going to crash and this, and they hate Joe Biden. And I will say I don't think he's the best president ever, but we've got a system that will get us on through. And you're not going to like some things, but instead of focus on all the negative, look at overall things. And again, we watch Fox Business, Fox is known for being on that side. CNN, which I think has come down a little bit, is known for the other side. If you're watching that stuff, you're going to get a distorted view. Kind of step back and say, well, what's really going on? And we've talked about different things. We talked about the price of lumber falling. We've talked about container shipping falling. I mean, all these other things are out there. And if you're still listening to the news, and that's what those news people's job is to get your emotions going. And I got to say, damn, they do a great job of getting people's emotions going. But it doesn't help with your investing at all. It's the problem.
And I got to say, too, is that the political side of the equation. And you and I have our political favorites, I'll say. But gosh, people make the stupidest decisions based off politics. They say, oh, you're not looking at it. Joe Biden is crashing this economy. The economy is just falling apart. Well, what numbers are supporting that? Well, do you see what he's doing?
Right.
And it's just such a political game. And the thing that we always come back to is these CEOs of companies, they don't care if Joe Biden's president. Of course, maybe they don't like all the regulations, but they're not closing their doors and saying, well, we're not going to try and get new business. Right. And guess what? In a few years, maybe now your candidate's in office. Well, now you could have missed a big run-up. Or maybe the stock market goes up, and then now again, you're left with the question, what do you do? Playing politics when you invest is, in my opinion, one of the stupidest things you can do. And it's a very harsh word when I use stupid, but I got to say that. It is a stupid decision because ultimately, it doesn't have a major long-term impact on businesses. Sure, you're going to have maybe regulation come in, and that's going to hurt companies. But again, 10 years from now, there's going to be changes to that regulatory environment that could be more beneficial down the road. So don't play politics. It's a stupid decision to make.
Yeah, things will ebb and flow, and I've said for years, don't pay attention to politics because your emotions get out of whack and you're not thinking. And what is our slogan that we've had for many, many years? No emotions, just results, because I've said there is no room for emotions in investing, which is with politics it happens because people get very emotional about it. And again, I did not vote for Joe Biden. I don't think he's a good president, but I'm not going to fold up my tent and go home and just put everything in the cash because I've said this for many years, probably 20 years. CEOs will find a way around whoever is in that White House. And you may not like things. Maybe it's not the perfect situation, but they will find a way to sell their product. Consumers will find a way to consume. And that's why we look at, the amount of money in the economy, the M2. We look at the job market, all these things that if you're just saying, I hate Joe Biden, he's terrible, he fell down the steps or whatever, it's like, that doesn't matter. It's the economy. So focus on that and get off the political side a little bit. And again, very emotional for people. But let's move on to something that I've talked about, and apartment rents. And as I suspected, the large increase in apartments is putting downward pressures on rents. Nationwide, rents have fallen about 3.5% since August. It was also the first time in 5 years that rent fell every month over the preceding 6 months. And here in San Diego, if one drives almost anywhere in San Diego, you see new apartment buildings going up. And nationwide, we are seeing the biggest supply of apartments delivered since 1986, with nearly 500,000 apartments coming online.
And this is really good for two reasons. First is that obviously people will be spending less money on rent. And the second reason as well is this will ease some of the inflation pressure since housing is such a large part of the CPI. So this is great news in my opinion. The other thing that I wanted to talk about as well is it could put pressure on housing prices.
Yes.
Because ultimately when you're looking at housing, it should be a function of rent. Mm-hmm. If you can rent out your house for X, that should then create a derivative of what the housing price is. If rents are falling, that means your house is probably worth less. So this is something, again, that I think is going to add pressure to the real estate market.
And the other thing it does, too, is that before people are saying, oh, well, I can buy a house about the same as I can rent a house or apartment, whatever. Well, that will be changing. The other thing I always say people forget, they forget about the opportunity loss or cost of not investing that money to use a down payment. But besides that, you kind of look at that and people say, well, gee, I can rent something for $2,500 or I can buy something for $3,500. I think I'll rent. And the other thing this will do as well is that if rents are coming down and you're in a rental situation and your landlord is having trouble getting people in, they may give you an incentive or not raise your rent. So this is positive. And it doesn't mean on Monday everything's going to be great. And this is why we project out 12, 24 months, because these are things building now that are trends that will happen throughout 2023. And I think 2024, it's a positive trend. So this is why we look at the raw data, as we call it.
And the other thing I was thinking about as well is when you actually look at multifamily like housing permits and housing starts, they're quite elevated to the long-term average. So this is in 2023, but it's not like those housing permits and housing starts for those multifamily starts are going to be coming on in 2023.
Right.
Those take quite a while to build and get going. That kind of creates a runway, not just for this year, but I think for 2024, 2025. And this is one reason I love capitalism, is when there's an issue, what generally happens, the market kind of fixes itself.
Yeah.
There's a rush to it. Well, unfortunately, many times there's too much of a rush, and then it causes prices to fall. The market's kind of going to be self-correcting, and again, this is appearing what's going to happen due to the I think the substantial amount of the multifamily housing coming online.
And you always have this lag because developers in 6 months ago say, "Oh, let's build this apartment building." They probably started that at least probably 2 years ago because you got to go through the phase of the permits and everything else you have to go through. That takes time. And this always happens with housing, is that you've got the big demand. The builders, developers go, "Oh, we got to fill this demand." Well, it takes them 2 to 3 years to get that started. By the time they get it started, like, oh, things have changed. And, this will cause many times the booms and busts, is that they get the supply on market, but it's usually 3 years late because it takes time to do that. So things are changing in the real estate market. I think for the good, it will help inflation.
And I did want to say one other thing. It is another post we wrote, but I just want to bring out this number just while we're on the real estate market. Is actually look at mortgage demand.
Yeah.
It was down 44% last week to purchase a new home. That actually registered a 28-year low. So
really?
There's, again, a lot of these issues ensuing in the real estate market. And I think we've seen a little bit of a pullback, but I think you're going to see more of a pullback just because you can't have interest rates at 7%. Unfortunately, I don't see interest rates falling because while we said we think inflation is going to decline, I don't think it's going to be to that 2% level by this year. So I think the Fed is not going to cut this year. You see maybe interest rates fall maybe middle of next year and kind of see where we're at then. But you just can't have housing prices maintain themselves and have interest rates more than double.
Right.
It just doesn't work.
And I still can't understand why somebody would buy a house in this market unless you're looking to have a house to raise your family, you want those schools, but any other reason to buy a house, I just don't get it. Again, 28 years, the lowest demand on mortgages in 28 years, you said. What does that tell you? Like, people are not doing it. Prices when that happens, prices have to fall to bring back that demand. And you just bought a house for, I don't know, $1 million, falls 10%, you just lost $100,000.
Yeah.
So, I mean, try to be smart with your money and, that's another thing with emotions. Oh, and then it's so fun getting a new house and, oh, wow, this is ours and so forth. It's a big asset. But if you step back and say, wait a minute, maybe this is not a good time to do this. So just kind of get your emotions out of investing you'll do much better. Let's talk about capital gains taxes because one of the major benefits of being a long-term investor is the benefit of capital gains taxes. Rather than ordinary income rates at the federal level, gains are taxed at 0%, 15%, or 20% as long as the position is held for more than 365 days. Now, in 2023, the standard deduction and income thresholds for capital gains increase, which is a benefit for investors.
And I think a lot of people may not realize that they could be in this bracket, but in fact, you may qualify for the 0% long-term capital gains rate with taxable income of $44,625 for single filers, and then $89,250 or less for married couples filing jointly. Now, what this means is actually you can still be able to make over $100,000 as a married couple and be in the 0% range because you got to take into account the standard deduction.
Yep.
So you add back, I think it's around $27,000 to that $89,000. Yeah, you're well above $100,000 there.
Right.
Not to mention, if you save money in your 401k, take that tax deduction.
Oh, yeah.
That reduces your taxable income. I mean, if you and your spouse are both maxing out your 401ks, let's say, I mean, there's another, just make it easy, about $40,000 that you can get there. I mean, you could get close to a little over $150,000 essentially to be in that 0% tax bracket, which is pretty crazy.
And again, it's a married couple, you make $140,000 a year. You're maxing out your 401ks. You're going to pay 0% on your capital gains. Why in the world would you go buy a house? You know, you're not going to your net worth will increase much faster in that 401k, and there will be a time to buy a house again where you get a good deal. Right now is not the time to do it, but gosh, you can pay zero tax on your investments and your 401ks, and what a great deal.
I mean, it's an awesome deal, and I think a lot of people they don't factor this in when they're doing kind of their tax planning. And you know, Harrison obviously joins us, our financial planner, every show, but we talked a lot about this, and he's like, yeah, a lot of people don't realize it, but there's so much you can do for the tax planning side of the equation to get people into those brackets. And you know, sometimes people they try and do the tax loss harvesting, but the thing that I kind of chuckle at, unfortunately, is they may not realize they're in the 0% federal bracket. So you're taking these tax losses, and they may not even be helping you.
Yeah, and people don't realize that. You're right, because they think, I want to save on taxes. Like, you save nothing. You just cause yourself more of a headache to do the tax loss harvesting, which the way we do it does take a lot to do, but it works out well. But we don't do it for our smaller accounts because they're probably paying no tax or even 15% tax. You know, it's many times not worth it.
On our lovely state here in California, we still got to pay our state income tax, unfortunately, on that. But I digress. Yeah.
All right. Well, let's progress to the crypto market, because another hit to the crypto market, Silvergate Capital, SI, a cryptocurrency-focused bank, plunged 58% in a single day of trading this past week. The reason for the massive decline was the company delayed its filing for the annual report as it needed more time to assess, I like this, additional losses, regulatory scrutiny, and the big one, its ability to continue as a going concern. In other words, they may not be able to operate for another 12 months. This is a major hit towards a potential bankruptcy. Not hit, but hint.
Yeah. Well, it could be a hit, too.
Yeah, both, I guess. Yeah, I should let that go.
The other thing we look at as well is we've stayed away from crypto, and we'll continue to stay away from crypto. We've seen the fall of FTX and other exchanges as well that have made the news, and now the major concern for Silvergate leads us to believe there are more issues around the corner with more exchanges. I'm going to say hint, hint, perhaps Binance. We've talked about that company a lot, and I just don't know if they're going to be able to avoid all the other issues that the exchanges have had. And I think if Binance falls, you're going to see some major issues with the crypto market, because that's kind of, I think, the last big one that's out there. Obviously, there's Coinbase as well. If they fell, I mean, I think it'd be done for crypto. But the thing that we also look at is it continues to fuel my belief that the argument for wider adoption of these cryptos, well, it's fading fast. I mean, people are, you had all these exchanges opening, kind of like we talked about capitalism, right?
Right.
All the supply came online. But that was what people were kind of, you see, like now you can get crypto here, you can get crypto here, crypto.com. You could get it anywhere. And it was making it appear as it was being adopted quite quickly. Well, now that adoption is shrinking. And I think it's going to make it harder for people to get into crypto. And yeah, maybe the best way to do it, and I've heard people, just do the digital wallet. I'm sorry, the digital wallet is confusing as heck to me. I don't want to waste my time on that, because I still don't see the utility of cryptocurrency. At the end of the day, that's why I will never touch crypto. I don't see the utility for it.
And also, it's very complicated. And again, okay, do that. Well, if you lose your password, you can never get in. You've lost your money, which we've talked about. There's probably money tied up in that forever because people lost their passwords, can't find it. It is just going to be, there's no reason for this. And we still have your advocates, you don't get it and so forth. They're still out there. But the thing we're trying to talk to people, if you have crypto, question yourself, why am I doing this? And we talked about Binance. I was kind of thinking about that. One or two things. I mean, this could be a positive for them because maybe they'll get all this other business. But the thing that we talked about over a year ago was auditing these companies.
Yeah.
They had stuff in the Cayman Islands, had all this other stuff, and we got a special the audits were terrible. Well, now because the government's saying we need to audit these companies, and they're doing that, and like with Silvergate, no, it's not good there. I think Binance, and we've heard nothing about their audit yet. I think if they have a true audit, you're going to find the same thing. There's a lot of problems that they have, and you'll have a big shutdown.
Well, the thing you have to think about is how do banks operate, right? Banks hold assets for people, but then they store those assets essentially, and they'll lend them out, and they're backed by reserves, and that's where the audit comes into play. Well, my question is for all these crypto companies, when they get these deposits, are they taking any of those deposits and storing them and like lending them out perhaps, or investing them? Let's say they're taking their assets and then investing them in crypto. Well, if crypto fell from 70,000 in Bitcoin down to, we'll call it 22,000 around where it's at now, do they have enough in reserves to have that liquidity for, let's say, if there is a bank run. And that's what these stress tests look at for banks,
right,
is if there's a huge change in the economy, right? And unemployment spikes, real estate falls, the stock market falls, can those banks still remain solvent? There's nothing like that for these crypto exchanges.
No.
And quite frankly, there should be if that's going to be an asset class. And I don't think they would pass any type of situation like that if we had a huge issue and crypto fell 40%, 50%, 60%, and the economy started declining. Because I think crypto obviously would decline much faster than other areas. So I just don't see how they would remain solvent, quite honestly.
And crypto is a currency, but the problem is you've got to make it easy for people to use and to understand it. And if you have these things falling apart, like Silvergate, FTX, it's making it harder and harder for people to do anything with it. And if Binance goes that route, it's like, well, what do you have? You have nothing. So it's just...
I'm going to push you back on that one because some people say crypto is not a currency. It's an asset class and it's an investment.
Crazy.
So it's what is it? At the end of the day, you have people that say different things about it, and that's my big issue with it is there's no true definition for it of quite frankly, its purpose.
Right.
And people say blockchain. Banks use blockchain. Yeah. Banks can use blockchain.
Yeah, blockchain is not exclusive to crypto. But people that are pro-crypto, but the blockchain, they're trying to get reasons why it's good. And it's false reasons what they're coming up with. And we have seen a lot of people lose money in crypto, and there's going to be more if they kind of stay in that path. There was no reason at all for Bitcoin or Ripple or all these other ones that are out there. It was just a hype that happened. And when you brought up the asset class, that was another thing. Oh, it's an asset class. Just trying to justify. Remember? Oh, it's like the
digital gold.
Digital gold. Yes, yeah. Like it's all hype that gets people to lose money. Just go out and buy a good food company. Be happy with an annual return of 10% over the next 10 years. Stop trying to become a millionaire in a short time frame because and I've seen people that get to be in their 50s and 60s and they've tried these hype things and they have a very, very poor retirement because they've lost all the potential and they've lost the years of compounding. I mean, if you're 25 years old, like, gosh, just start putting your money away in your 401k, earn 10%, you're going to do great. But stop getting into these high risk things.
One last thing that I wanted to talk about on the crypto is just how we were talking about the digital wallet.
Yeah.
I saw this thing on social media the other day, and I've heard stories like this before, but it was just this guy, I guess, has like $200 million in Bitcoin, but he has 2 attempts left on his.
Oh, gosh.
And it's like, again, this is something that with crypto that there may be a floor for Bitcoin because this is going to continue to be a problem. They're not going to fix this problem ever. Once you get locked out, I think that Bitcoin is just basically dead water.
Yeah.
So you're creating this class where the supply continues to shrink because people are so excited about it because now they can't access it anymore. Yeah. And it's craziness. So I don't like crypto. It drives me crazy.
And we talk about try to help people out. And if you know somebody that has crypto, I mean, just talk to them about it. They're very emotional. Again, no room for investing with emotions. And that's what they're doing with crypto. So that's why we do it, to kind of keep you posted what's going on with it. If you want the free newsletter, because we get this information from the newsletter that we do, it goes out every Friday at 5 o'clock. It is free. Other topics we talk about in the newsletter this week were natural gas, the U.S. power grid, venture capital funding, Bitcoin's future, a different article on Bitcoin, real estate, ESG bill. Again, this is all free information. It probably takes you about 4 to 5 minutes to read the newsletter, but you get a lot of great information out for it. Go to our website, smartinvesting2000.com. Again, that's smartinvesting2000.com. Go right to the center of the page. You'll see up on the middle there, it says sign up for our newsletter. Do that, and you'll get the free newsletter. All right, coming up, we got Harrison coming up later. He's going to talk about alternative investments and retirement accounts. We do have our phone lines are open for the calls for that unbiased, no strings attached, fundamental opinion about what you want to talk about. Phone number 833-288-0973. That's 833-288-0973. And as promised, let's talk about 3M for, who was it, Tom here. Because Tom does say, I love to listen to the show via podcast and was wondering if you could look at 3M. I currently own the stock, and I'm wondering if it's a good time to buy more. Now, a couple of things Tom didn't give us, like, well, it could be a good time to buy more, but did not mention how much he owns percentage-wise in his portfolio.
Yeah, I generally tell people if you own 1-2%, yeah, it could be a good time, depending on, of course, the company. If you own like 7-8%, know you're going to over-concentrate yourself in a company. And we always tell people, I mean, as much as we like the companies we invest in, you never know what's going to happen. Remember this little thing called COVID?
Gee, that brings a slight bill.
Nobody knew what was going to happen. And I mean, honestly, it destroyed a lot of retail companies and destroyed the fundamental concept of investing in those. So, I mean, you never know what's going to happen to a company. We talk about China. There's all these different things that can arise. That's why you never want to be over-concentrated into a company.
And I got to say, I'm a little bit excited to kind of look at 3M because it's a business that we would like to buy. No, they've had legal problems, which is one thing that I'll say before you look at the numbers. You've got to look at what those legal problems are because it can go on for a while and cost them money. And then will they pull out of this? So let's take a look at 3M. Their symbol is MMM. Only 2.4% float on the short side, so people don't think it's going to go down that much. 68.5% institutional ownership. That's lower than I thought it would be. You do have a good PE ratio of 10.9 versus 11.5. Price to sales expensive 1.9 versus 0.6. Price to book value 4.2 versus 1.1. And price to cash flow is also expensive 11.3 versus 7. And I will point out there's no PEG ratio, which is your price earnings divided by growth. For the industry, it's 45, nothing for 3M. So I don't like seeing no PEG ratio there. We do see over the last year the earnings are up 0.6%. Sales did decline by 3.2%, but the industry was up 21.2%. They are in the industry of conglomerates, so that's really not helpful because conglomerate can be any type of industry, so that doesn't really help you much there. We do say they pay, a 5.4% dividend, only use 58% of the earnings to pay that out. Taking a look at the balance sheet, current ratio 1.5, better than the industry at 1.4. Debt to equity 1.1, about the same as the industry, so I'm okay with that. We do see a net profit margin of 16.9 versus 6.6. That is good. Return on equity 39.2 versus 15.8. Return on invested capital 18.9 versus 9.9. So some positive things here. Let's see what you got going forward, Chase.
Yeah, well, to start, current price here for 3M, again, MMM's, that ticker symbol. $111.26. The 52-week high here, $154.66, and the lows, $106.76. Year to date, the stock's down 6%, and over the last 1 year, it's down about 22%. Well, I go forward to December 2024, I do see estimated earnings per share of $9.49, would give us a target sell price of $157.53, which means it trades at a forward PE multiple of around 12. That would place it in the buy category for us based off the valuations for the company.
What was your target sell price again?
$157.53.
Oh, okay.
And one thing I did want to point out is this year it looks like earnings are estimated to decline about 14%. Next year they're estimated to reaccelerate around 10%. And one thing that I wanted to know more about with 3M is they were a benefactor from COVID. The masks.
The mask, that's right.
And I don't know how much of their business came from that, though. But if they got a big influx of cash, let's say, that could be one reason why sales and earnings could be declining. But again, I don't know, just very surface level here, how much of that business was a big benefit to them.
And I know they have a lawsuit. I forget what the lawsuit's about. And that's a very important factor. And one thing I did notice, too, that 90 days ago, the estimated earnings for 2024 were $11.04. So they're coming down quite a bit. Does that say that you have the potential they're going to lose this lawsuit and have to pay out billions of dollars? I also do see the range is pretty high in that estimate you gave. It's low 820, high 1020. There's 19 analysts. But I like, this is the type of company that I like, and I almost feel it's worth the research to look into it. The thing you don't know is where, as a conglomerate, where does it fit? Because we like to buy, food company, insurance company, transportation company. Conglomerate's kind of hard because they've got everything in their portfolio.
And that's one thing that concerns me. I like the name 3M. I like a lot of their concepts. I mean, they do like Scotch tape. They do, like I bought some of their
Post-it notes.
I mean, they do a lot of just simple things. It's a very simple business, but then it gets more complex because of that conglomerate factor. And, I want to buy it, but the issue I have is when you're a conglomerate, it gets so hard to manage the company because there's so many different things going on, and it's hard to be an expert in, we'll call it, I don't know how many different businesses they have, but we'll call it 10 different businesses. It's very hard to be an expert in 10 different businesses at the same time.
Right. And I believe their stock price was, I want to say over 200 at one point in time.
I saw their 5-year return is down like 50, no,
40,
5-year returns down 42%.
42, yeah, 42%. And I think their stock was over 200 or close to 200, which means this company's perhaps on a 50% sale. So I like it. But again, before we invest in a company, it's 10, 15, 20 hours of research. We're looking at some other companies now, but I just always think about 3M, but it would take a lot of research to understand what's going on. And I bought companies before with lawsuits, and it did very well because they eventually do settle. Many times it's insured. You got to look at that. Could the insurance step in and kind of cover it for them? It's also a tax deduction for them. So it could be that all that's baked into their price right now. And you could get a great company, good conglomerate at a decent price. So going back to Tom's question, Tom, I mean, it may make sense to add to it. Again, I would really encourage you to look more at what the company does, what the lawsuit is. And if you own, I'd say more than 2 or 3% of the portfolio, that's enough to own that to it.
And I think the COVID benefit would be a benefit. Because I think
benefit would be a benefit
because they got that big spike in sales,
right?
And I think one reason the stock is falling is now because sales and earnings are declining. So if they got a big benefit from that, well, we know that now that's coming down, but then they can reaccelerate the business. So it's kind of a negative benefit.
Well, and that's when you want to buy a stock, an equity, when it has bad news. You don't want to buy it when everybody, oh, we love this company, we love this company. You're just joining the crowd, and you're probably overpaying for it. What was the forward PE on this? I think you said
about
12. I mean, that's pretty attractive. I mean, you compare that to the high flyers, the Microsoft's at 30, and all these other ones. I mean, it's crazy. And what will happen? And people think, oh, the market's going to crash this year. The overall market, maybe the NASDAQ will have more problems because they're still very pricey. You buy a 3M at 12 times forward earnings. I would say in 2 to 3 years, you're probably going to make a decent return.
Plus what, 5% dividend? Is that what it was?
Yeah, 5% dividend. So there's 15% over 3 years right there.
Yeah. I mean, at 5.4% even. And the thing I was going to say as well is it seems like conglomerates are so much less common than they were several years ago. I mean, obviously you've had GE, right, which has now been spinning out different businesses. I mean, that's something that maybe 3M does as well, and maybe that benefits them. It gives them optionality, and if you're getting these companies at a good value, they could simplify those businesses. And I generally like to see when companies go through those restructurings, as long as you get them at a good value, right, because then they can create more value for its shareholders. So, I mean, that's a very big speculation on my part, but it's something that could happen.
Yeah, and we have what we call a watch list. I think there's like 6 companies on there now. I would kind of like to add 3M to that, but it's just that's why I love doing this. I mean, it's so exciting looking at these businesses and so forth. I would love to just read all the time and do that. I guess that's what Warren Buffett does, but my fiance would not be very happy about that because we got to go to the dance, we got all this other stuff. But it's just I like 3M. I have a feeling that it's worth getting into, but you got to do the research no matter who the company is, because it could be something that could blindside you down the road.
And I'll tell you what, it's not going to go to 200 next year.
No.
Very unlikely it does. But as you said, I mean, you get that 5.4% dividend. Let's say the stock goes from 110 to 130. I mean, you made a very nice return there on this company.
And I was going to say from 111 to 121, and the dividend over 3 years, that's a 25% return in 3 years. I'd be pretty happy with that. It's about an 8% gain over 3 years. And I think that would even be low over 3 years. Yeah. I think you'll see much more in that company. Barring what the
further research is.
Further research, yes. I want to make sure we stress that. All right, phone numbers here. Gosh, all lines open. 833-288-0973. Again, that's 833-288-0973. You got an investment question. Maybe you're new to investing. Maybe you're not sure about certain things on investing, or you have an equity that you're talking about that we're looking at, or that you want us to look at, that you're just not sure. Should you stay in it? Should you buy it? What should you do? We'll give you our second opinion on what we see based on the fundamentals that investment you're looking at. Again, 833-288-0973. Well, let's go to our financial planner, our CFP, Harrison Johnson, talk about alternative investments and retirement accounts. Good morning, Harrison. How are you doing this morning?
Morning, guys. I'm doing well. I'm calling in. I'm not in the studio anymore.
I know it. We miss you.
Out.
Right. well, I find this interesting because alternative investments and retirement accounts, and I'm not a big fan of them. So I'm kind of curious what direction you're going with this because, well, I'm just going to give you the microphone.
Or the phone.
So, yeah, exactly. I wanted to talk about this because it seems like we've been seeing it more frequently where clients will come over and they've got alternative investments sometimes in their IRAs that's transferring over. So an alternative investment is something that's not your typical stock, bond, ETF, mutual fund. It could be private equity, could be venture capital, hedge funds, commodities. But typically we see them in some type of real estate investment like a private REIT. So private real estate investment trusts are illiquid by nature. So if you buy one, you might not get your money back for a while or potentially ever. So this can add an extra degree of risk. And as far as holding one of these in a retirement account, if you end up losing money on that, you can't write off the loss. That's true with any type of investment in a retirement account, but investing in assets that are more risky have a greater chance of loss, and therefore you could lose the ability to deduct that loss. Also, when you're taking RMDs, the lack of liquidity can be a real problem when you need to withdraw funds. Now, if you have other liquid assets in IRAs, you can take distributions from those other areas. As long as your total RMD is taken, it doesn't matter from how many accounts or assets it comes from. So this is something that can be planned for. But if you had a lot of alternative assets, you would need to deplete a lot of your other liquid assets to satisfy that RMD. And if you don't, whatever you don't take for your RMD has a penalty. Penalty used to be 50%. They just reduced that to 25% a couple months ago, but 25% is still a really large penalty in addition to taxes. I was telling Chase I was reading about an alternative investment company, and one of their recommendations for taking the RMDs from alternative investment is just to pay the penalty on it. So, not a good recommendation in most cases. And then lastly, and probably most importantly, the value shown on your statements for your alternative investment holdings doesn't always match its true value. For example, you might have something that has a price of $10 a share, but if you went to sell it, maybe you would get 50 cents a share or something like that. However, your RMD calculation is still based on that $10 a share. So not only are you paying more taxes than you should, but you could be paying taxes on assets that you don't even really have.
Yeah, and I think it is so important because a lot of people don't think about this, and unfortunately, a lot of people are just sold these products. I want to be very clear. When you said we're seeing more of this, again, it's not from us putting people into these. It's,
right.
As you said,
right.
people bringing money over. We will never touch these. It's just, in my opinion, something that's not worth going into. There's so many other public options that you can go into and out of, and these alternative investments, I think, are much riskier than people realize.
And I think these alternative investments, I do not like alternative investments, private equity, annuities, all the stuff that people can't see. And they say, it's much better than the stocks because stocks are volatile. If you understand how great stocks are, because keep in mind, these companies are regulated by the SEC. You can have all the information about what that's doing. On these alternative investments, private equity, it's all behind a curtain. And you don't know what you're getting. And most of the time, and I forget the numbers, but most of the time they don't do very well. But they're sold, and that's the problem. They're sold. They're not managed.
And the other issue I have with it as well is, let's say you want to get into real estate because you think real estate, it's a great time to get into real estate. I'm talking several years ago, obviously.
Right.
But now you think it's a bad time to be in real estate. I want to get out of real estate.
Yep.
Well, that's too darn bad. You can't get out because you did a private investment. So that's why I would never touch them. I don't like not knowing when I'm going to get my money back. That's a big concern that a lot of people, I think, bypass. And again, these private REITs, these private investments, they still have the volatility. You just don't see it.
Yeah, you just don't see it. And it's all behind the curtain, as I said. And I would think as a financial planner, when you see that, like, oh, gosh, because you can't do anything with it. And you bring up a great point, too, about them being a retirement account. What if you've used all your other liquid assets? What do you do now? You've got to get rid of these alternative investments, probably at pennies on the dollar.
And it's not even... If you've gotten rid of all of them, that's a bad problem. But you still have to get rid of like good performing assets, perhaps. So you have this private investment, and now you're depleting maybe good quality assets that you have to sell because you don't have any other choice. Right. I mean, that's another problem as well.
That's a great point, because you got to sell good assets because you got the bad asset, you can't do anything with it. Yeah. So Harrison, when somebody comes to you, a financial plan, and you see that, what do you do?
Well, in most cases when it happens, the people that own them don't really understand what it is, how they got it, what their options are. So in some cases, we're able to get out of them. In some cases, we can't, or, it just doesn't make financial sense to. But it's something that you have to continually monitor, because sometimes they can only be liquidated certain times of the year, or, it might take a few years to fully get out of something, and you're doing it at a fraction of what the value actually is. So again, this is at a fraction of what the value actually is. So again, this is it's sold as a way to invest in real estate, but it ends up acting more like a product, because there are commissions that come along when people sell these things, and you can't really get out of it. So if you want to invest in real estate, like you guys said, you can invest in public REITs that are much more liquid, still have the same underlying assets. You can invest in traditional real estate. I think there's a lot of other better ways to invest in real estate if that's something that you really want to go down. But this is not a way that I would be interested in investing in real estate. It complicates things. It adds a whole lot more risk, and it's just, I think there's a lot better alternatives.
And I think people get excited about we have in real estate, this is great, and so forth. They don't look through behind the curtain.
Well, it's sold behind the diversification. Nonsense, in my opinion, as well. It's like, you need to diversify into different asset classes. So this is a great option that pays me a very nice commission.
Yeah. Well, Harrison, thank you very much. We appreciate that, and hopefully a couple people learned that don't do alternative investments in your retirement account.
Yeah, absolutely, guys. Well, I'll see you in a few minutes.
Yeah, we'll see. Yeah, today's our client event, so we'll see you in a little bit. All right.
I want to say one more thing on the alternative investment. It's kind of not funny, but we have a client that came over to us, and they again have an alternative investment in there, and we got this thing that we could redeem the alternative investment. Right. Oh, great! So we can get out of it. Well, we called Schwab, and they said, at best, when I've seen this, maybe you get like 6% from the redemption of the position.
So that's 6 cents on the dollar, you mean?
No, not. You get the full amount, but let's say you have 100 shares, you might only be able to redeem 6 of the shares.
Oh, 6 of the shares.
Because we got the letter and we're like, oh, great, we can get out of this. That's great news at the beginning of the year. And they said, well, it's kind of based off of how much they're releasing and the other people that want to redeem their shares as well. So then it's kind of a auction type thing. So you might only get 6 of the 100 shares.
So at that rate, it would take you about, 17 years to get out of it completely?
Yeah.
Wow, yeah. Don't do alternative investments. Yeah. That's all we'll say. Stay away from them. If you're sold them, say thank you very much and move on to the next one, because it's not going to do very well for you. All right, phone numbers here, 833-288-0973. That's 833-288-0973. And I forgot to mention, too, if you want a free consultation with our financial planner about financial planning, he's on a fee base. He is not going to try to sell you annuities or insurance or alternative investments. Give us a call at the office at 858-546-4306, 858-546-4306. Just listen on the prompt for Harrison Johnson. Or you can go to the website as well, smartinvesting2000.com. That's smartinvesting2000.com, and just send Harrison the email, and he'll get back to you about a free consultation for financial planning. All righty. Let's go out to, I look over the people keep changing. I guess people hanging up on us. I'm trying to see who was here first. I think let's go out to El Cajon and speak with Bill. Bill, you're on the Smart Invest Show with Brent Chase. How can we help you out?
Good morning, gentlemen. I'm looking to take a long-term investment in Boeing, ticker symbol BA.
Okay. Now, when you say take a long-term investment, I think you don't have it yet. Is that correct?
No. At one time I did own it, and I sold it many years ago. But so I want to get back in on it, and I want to hold it. I don't own any shares currently. Okay. And I will tell you, we are long-term investors. We like that idea. But the other thing, too, is you always have to look at your businesses, because we would sell any business at any point in time if it became overpriced or the fundamentals broke down on it. So being a long-term investor is good, but you can't just buy it and tuck it away, because who knows what could happen 5 years down the road if you're not watching it. With that said, let's take a look at Boeing. Their symbol is BA. They're in the aerospace and defense industry. Low float on the short side, 1.4. Only 59% institutional owned. That's pretty low as well. They still do not have a PE ratio, no earnings, so that the industry is at 70.5. Price to sales, 1.9, same as the industry. Price to book value,
not material. So this tells me that their liabilities exceed their assets, and therefore they're not worth anything based on their assets and liabilities. That's not a good situation. And price of cash flow of 36.5 versus 19.5. Now, the last year, earnings have done nothing. Sales are up 6.9% versus 1.5 for the industry. That is good. This 5-year growth rate looks kind of crazy to me, 93.8% 5-year growth rate. And I know they've had a lot of people like India and others buying planes. That's probably why you get kind of excited about it. The industry is at 20.6. They do not pay a dividend. They stopped that dividend, I think, a few years ago. Look at the balance sheet. Current ratio 1.2 versus 1.5. That's positive. Now, no debt to equity, and that's because they have no equity. I do remember a year or two ago, the CEO brought on, I believe the number was about $40 billion in debt to keep the company going. That debt is still there, and that interest still needs to be paid. So I think a good look at the balance sheet would be important before you invest into Boeing on what that debt is. Now, the net profit margin is still, and this is over 12 months, a negative 7.4% versus positive 4.2, so they lose 7 cents on every dollar they bring in. Return on equity is good, 31.1 versus 11.8. Return on invested capital, a negative 5.8 versus 7.2. Chase, I'm very excited to see what you have to say about Boeing going forward there.
Well, I did pull up that debt because you got me intrigued. And, it looks like in 2018 they had about $10 billion of long-term debt. 2019, $19 billion. So that was pre-COVID, and that was still a huge increase. I don't know why that increased before COVID. 2020 jumped up to $62 billion of long-term debt.
They added $40 billion. And that's how I got to say, wow. Yeah. I knew $40 billion was there somewhere.
It has come back down to about $51.8 billion, but they're still, again, about $30 billion in debt.
Right.
Due to COVID.
Has to be paid, and the interest on the debt has to be paid, yeah.
Yeah, and I was going to say this. One thing that I would really want to understand if I did buy Boeing is how do they get through COVID? We know, again, kind of like I talked about at the beginning of the show, you can't predict these situations, which is why I would never want to be overconfident in a company. This really, really hurt a company like Boeing. And for them to get through it, it could have really set them back quite substantially. So I would want to understand how they got through it. Those debt levels, that could be a major problem. But looking at the numbers here for Boeing, I do see the current price is $215.11. 52-week high is $221.33, and the low is $113.02. I did look it up because I remember Boeing was around $400 a share. That was back in 2019. So obviously COVID did derail them quite substantially, so it's come back down substantially from that level. But looking forward to December 2024, I do see estimated earnings per share of $5.43. It would give us a target sell price of $90.14, so not very attractive. But what I will say, it's not going to say that I would ever invest in it, but it's kind of funny to think Boeing has now become a growth company. They're looking at having their earnings grow at a very substantial amount because last year, they are growing. They lost a substantial amount of money. This year, they're estimated to still lose 7 cents. But then next year, it's again that 543. And the analysts do in 2025 have an estimate for 896. So they're estimated to grow their earnings very, very nicely. But I just don't like to kind of guess in that regard. And I think they have a lot to work through is the problem. And it's, I think, a lot riskier than a lot of people would think to have a company like Boeing. Your mic's up.
Okay.
Yeah.
Oh, okay. And I think, too, what to kind of look at with Boeing is that I know they've had a lot of, like India and I think some other places where, yes, they're going to buy these planes. How strong are those contracts? Can they back out of them? Are they just like many times with housing, like sign contracts, but they're not, so you got to understand that as well, because right now everything is very positive on the news for Boeing. And when we buy a company, we want to be confident that it's going to go forward. So I want to know how those contracts, are they strong or not? Because if they go away a year from now, this company could go back down to 100. They got all that debt.
And especially if we have a slowing economy, especially a global economy, I don't think airlines are going to be adding planes. And we know that the airlines as well had a very difficult time during COVID. What's their ability to continue to add to their air fleet? So there's a lot of questions here. It doesn't fit our build for a value company. I can kind of see, I guess, the argument perhaps to invest in a company like Boeing because of that potential growth in earnings, but it's just something that I wouldn't invest in.
Yeah, and with those earnings going forward, it's trading at a very, very high multiple.
Everything has to go right for them.
Yeah. So Bill, we as you can tell, we kind of hit it pretty hard. I know there's a lot of great news on it, but I think if you get into it, I'm going to tell you, don't buy it. Don't buy it.
I think it's risky.
Yeah, risky. There we go. All righty.
Okay, thanks. The reason I like it is because who is their competition? They only have one competitor. And if you're going to go buy planes, you either have to go to Airbus or Boeing. Mm-hmm. So that's why I like it.
Right. And that can be very possible. Keep in mind that a company, and this under General Motors, they can file bankruptcy. All their shareholders lose everything, and the business continues on. And that could happen with Boeing as well. And they've got a lot of debt. What do you say, $50 billion?
It's now $51 billion.
$51 billion, yeah. So they can file.
That's just long-term debt.
Long-term debt, yeah.
Yeah. How long have they been in business for?
That's irrelevant because GM was in business for, 100 years, and they filed bankruptcy.
Yeah.
So never say.
True. Okay.
Yeah.
Sure.
They've been in business forever. That doesn't mean that things can change because when you invest, you got to look at, everything in the past is great, but what do things look like going forward? So be careful there.
Okay.
All righty?
Okay, thanks, guys. Much appreciated. I always appreciate your help.
Okay, Bill. Well, thanks for calling. You have a good one.
Okay, you too.
Bye-bye. All right, let's head out to Massachusetts and speak with Jeff. Jeff, you're on the Smart Investing with Brent Chase. How can we help you?
Good morning, gentlemen. How are you guys doing today?
Good. How you doing?
I'm doing great. I'm calling about Nike, NKE.
Do you own that or looking at buying it?
I own that, and I'm looking about adding to it, I guess.
I know, and we'll go through this. I know Nike went way up, and then they've kind of pulled back a little bit. So I'm kind of excited here to look at it here with you. Coming again is Nike. Yes. Their symbol is NKE. They're in the footwear and accessory industry. Only 1.2% float on the short side. Institutional ownership 83%. That's pretty good. PE ratio is still pretty high, 34.1, but the industry is at 31.2. We do see price of sales 3.9 versus 2.3. Price to book value 12.8 versus 39.4. And then price of cash flow checks in at 71.9 versus 44.8. And the PEG ratio is 6.1 versus 33.3. And that's a positive. But PEG ratio is lower. That's a positive. So I do like seeing that. Now, unfortunately, earnings year over year are down 6.6%, but the whole industry is down 7.4%. The sales grew by 4.9%, which was better than the industry growth on sales of 3%. Their 5-year earnings per share growth estimate by the analysts is 6.8%. That is above the industry at 4.9%. They do pay a small dividend of 1.1% and use 35% of the earnings to pay that out. Looking at the balance sheet, they got a current ratio of 2.7 versus 2.5. That's good. Debt to equity looks okay at 0.8 versus 0.9. Net profit margin, very good, 11.5. I say that because the industry is at 7.7. And return on equity is 36.9%. That's a pretty good. We like to see a company above 15%. So I like these numbers, but it kind of depends on, Chase, what you say, because I have a feeling that's going to be rather pricey on what we're paying for the earnings.
Yeah, so to start here, current price for Nike is $120.94. 52-week high is $139.86. And the low, I remember this, was $82.22. I remember they had an inventory problem last year, but it's come back up substantially from that low.
That was probably the time to buy it at 82.
Yeah, well, even then, I'll say it's a little pricey. I'll give it a little bit away, but year to date, up 3.7%. 1 year, down 8.5%. Now, going forward for Nike, I'll go out to May 2024. They do report on a fiscal basis rather than a calendar year. I see the estimated earnings per share is $3.98. Will give us a target sell price of $66.07. So it trades at a forward PE of about 30 times earnings. I mean, that's very, very pricey. We know the long-term average is around 16. And one thing I've talked about before with Nike, I like having brands. I don't like to buy retail centers anymore. I like to buy the brands. Nike is that. But one thing that concerns me about Nike is, where is this growth going to come from? I believe there's more competition coming online. I mean, you look at a company like Lululemon, a company here in San Diego that I love. It's Vuori. I mean, who? It's called Vuori. I bought you that for Christmas. The very soft shirt.
Oh, yes. Yeah. Okay, the shirt. Okay.
Yeah. And it's. I think there's a lot.
I'm sure he wears it all the time.
Yeah, I know, right?
Don't say anything.
Yeah, I can tell by his.
Yeah, what is that? Yeah, but it's a.
You bought your shirt.
Yeah, my point is there's a lot of competition that I think is coming into this kind of athleisure type trend that really occurred during COVID. And the other thing too is COVID brought on this athleisure trend. I think we could see somewhat of a reversion from that. So my big question for Nike is, earnings are estimated to grow 27% year over year. Where is that growth coming from?
Yeah, and Jeff, I mean, it is a great company, But as Chase brings out, I mean, where's the growth going to come from? And how? I know they're big for their shoes. They're trying to get other industries that, again, maybe they can't compete at. I do think their earnings have come up from 377 to 398, which is positive, but you're still paying, what, 25 times earnings for this company? 30 times earnings. I mean, it's.
Well, they keep on talking about China opening up, and it's a big market for Nike. And you just said today, and this is something that makes a lot of sense. You know, don't buy a company because everyone's rah-rah about it.
Right.
Buy a good company that's in trouble. And when they had that inventory issue and the shares were like $82, that's when I started buying it. I bought it all at that inventory problem. So, Nike was always kind of a popular brand. Everyone wore Nike, and they go shoes, they got apparel and everything else. But I never thought about it until they had that inventory problem, and the stock went way down to 82, and that's when I got in.
Yeah, and that's exactly what you want to do. And now you have the situation where now you've made about a 50% gain. Do you sell Nike and try to find another company that has a problem? Yeah. Not to say Nike won't go up, because it has to fight a lot. It's got that brand name to it. But and again, if we do have a continued slowdown in the economy, I know their sneakers are expensive. I'm not a big advocate of it.
The other thing too is you bring up China, and I know that they kind of took some flack for it years ago, using Chinese labor to do it. I'm curious how much of their supply chain still comes from China, as we know there's a lot of rumblings about issues between China and U.S. relationships. If they do deteriorate further, that could be another major headwind for Nike.
Yeah. So.
Yeah.
Yeah.
Because I was thinking about holding it, or I made a decent gain, maybe part ways and get something else.
And here would be my suggestion: sell Nike. Doesn't mean it's not going to go up, but sell Nike and do a lot of research on maybe 3M. Look at 3M. Or
I was thinking about that, and I was thinking of Allstate insurance too. I was thinking about those 3M. You brought up some interesting points about 3M today, so I appreciate that.
Yeah, because you did good buying Nike when I was at 88 for the inventory problem. Find another company, another problem, invest in that company. All righty?
Sounds good. Thanks, guys. I appreciate it.
All right, Jeff.
Always.
Thanks for calling. Have a good one.
Right.
Bye-bye.
Yeah, take care.
All right. Today I was on the phone line, but I only got a couple minutes here, and we are all dressed up today because today is our investment symposium that we do that's for our clients, where we talk about everything going on in the economy. We talk about what's going on in the portfolio. This is something we do twice a year for our clients and our clients love it. I always talk about when I first started doing these back in 2009, we had about 10 people show up. We now have over 200 clients show up to it.
Yeah, no, it's always exciting to have the client events, and it's something to come back from, again, vacation and ready to roll on it, but it'll be a good time.
Yeah, it's a good time. And they get a nice brunch. I mean, it's always hard because they're eating that brunch and what they're talking like, oh, gosh, that smells so good.
Yeah, I know. I was going to say, though, on Nike real quick is just, it's always a shame because I used to love Nike. I mean, in high school, we were in Adidas school at Poway High.
Oh, yeah, I remember that.
But I always liked Nike. But now, I think I have one pair of shoes that are Nike, and that's it. I haven't bought a Nike piece of clothing in, I think, 3 to 4 years, or those were the shoes that I bought.
And, and I just bought a pair of shoes, I think about 3-4 months ago because mine wore out, and I went to Under Armour. And I tried Nike. I just liked the Under Armour. They were more comfortable. They felt better, and I think they're about 30% less in price. Is what I'm thinking. They feel better. Why am I going to spend 30% more just to get the Nike symbol on them? No, I'll buy the Under Armour ones.
Yeah. So, that's the thing is consumer preferences change, and that's one thing that's really hard about retail as well. Mm-hmm. Is it's nice to have that brand because you kind of control the sales a little bit more than if you're like a distributor, let's say. But the problem is if you miss on some of the fashion trends and so forth, there could be some issues.
And that's why you buy it on sale, because you pay the high price for it. And this can happen where they miss the fashion trends. That will drop
50%.
Yeah, I was going to say 20, 30, 40%, but it will because they missed that. And now what have you got? Now you've got a company trading at maybe 14 times earnings that you paid 28 times earnings for. You should have waited. And it's just you never want to be the guy that buys at the top. You try to find things on sale, which has been our philosophy 40 years. Yeah. So, all righty. Well, this is Closing Bell. Thank you for listening to the Smart Investing Show. It is for informational purposes only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-546-4306. That's 858-546-4306. 546-4306. And be sure to visit our website, smartinvesting2000.com. That's smartinvesting2000.com. A lot of great information there. The newsletter's there for you. So go again to smartinvesting2000.com. Have a great day. We'll talk more next week right here on the Smart Investing Show.
So amusing to think that I did all that. And may I say,